Hello, everyone. Good morning, good afternoon. Welcome to another Canadian Lenders Association webinar. We're very excited to be hosting this. This is going to be our last webinar of an incredibly exciting and crazy year. Before we begin, I'd like to introduce the Canadian Lenders Association to those who don't know. We are the largest community for lenders in the country. So if you are a lender yourself or a service provider to the lending industry, we would love for you to join, take a leadership role in the organization, help us advance really critical policy issues that are transforming this industry. So with that, I'm going to hand things off to today's moderator, Elizabeth, partner at Osler. Elizabeth.
Thanks, Tal. Hi, everyone. Great to have you with us today. So as Tal mentioned, my name is Elizabeth Sale, and I'm a partner in the Financial Services Regulatory Group at the law firm of Osler. And I specialize in the regulation of lenders and other financial services providers. I'm really happy to be here today and to have the opportunity to moderate this panel discussion on the very important topic of financial resilience. Financial resilience is a very timely topic as we move into what I certainly hope will be the last final phase of this pandemic. But I think it's going to prove to be the most difficult phase as public and private relief programs dry up, but a fully open economy is still many months away. So first off, I wanted to introduce our panel. Because we're on Zoom, I'm just going to ask our panelists as I introduce you to raise your hand so that people know who you are. And so in alphabetical order, first off, we have Elizabeth Billiard. Liz joined BMO in 2018 as head Canadian Consumer Risk. Liz has held a series of senior leadership roles in retail credit, having worked in both business and risk management roles with accountability for unsecured lending, auto loans, credit cards, deposit accounts, and real estate secured lending. Next up, we have Eloise Duncan. Hey, Eloise. She is the CEO and founder of Seymour Management Consulting Inc. Seymour Consulting is a Canadian financial services firm that is the leading independent authority on financial health in Canada and was the first to measure financial health across Canada in 2017 through its Longitudinal Financial Health Index studies. Eloise is also the creator of the Seymour Financial Resilience Index, launched for Canada in May of this year. Next, we have Simon Howard. Simon is the Director of Business Development Canada at Illion Digital Tech Services. He's been with Illion for the past 4 years and has over 20 years experience working in credit risk and collections as a consultant for leading bureaus such as Equifax, Experian, and DNB, where he developed innovative data and technology solutions. Next is Kareem Nanji. Kareem is the CEO of Marble Financial Inc. Marble's focus is financial inclusion for Canadians who do not have access to useful and affordable financial products and services that meet their needs, and to deliver such products and services in a responsible and sustainable way. And finally, we have Amit Sadhu. Amit currently leads unsecured and POS lending business and enterprise newcomer segment for RBC. Amit has 18 years of retail lending experience across Canada and the US, leading various product and risk management teams. So that's your panel for today. We're going to start off by a brief presentation by Eloise, who will speak to some highlights from the Seymour Financial Resilience Index from before the pandemic, and that's based on the February index baseline and based on the June and October index data. We're then going to get into a panel discussion on the implications of this data and the opportunities that present themselves. We're going to try to leave some time for questions from the audience after the discussion, so please feel free to use the chat button and type in your questions. I'll be looking at that, and hopefully we'll get to those towards the end. Eloise, over to you.
Okay, thank you so much, Elizabeth. So, and thank you, Tal and the CLA for inviting me to present and being on this great panel. It's very exciting. I also, before we start, just wanted to thank my colleague Queeton, who has done an incredible contribution and job to supporting our index analysis. So I'll just speak for a few minutes around the change in financial resilience of Canadians, and how we define that is really a household's ability to get through financial stressors, shocks, and hardship as a result of unplanned life events. So our index, as Elizabeth said, measures this with a baseline index data of February 2020, before the pandemic affected Canadians, and it measures and tracks the financial resilience for households across 9 behavioural, sentiment, and resilience indicators at the individual household, segment, provincial, and also national levels, as well as for bank customers. So the index is grounded in 4 years worth of longitudinal data from our financial health index studies, which are based on very detailed online surveys with a representative sample of Canadians by household income, province, age, and gender. And what we're seeing here is just some of our key indicators for the index model. And what is important here to note is that debt-related indicators, there are only 2 of those of the 9 composite indicators. So this is a very holistic measurement of consumer financial health and resilience. So people are scored from 0 to 100, creating 4 financial resilience segments, from extremely vulnerable on the left-hand side to financially resilient on the right-hand side. So just a couple of summary highlights. 72% of households are actually not financially resilient, based on our index model. So that really represents over 16 million Canadian households, adult households, as of October. And we are seeing, so that financial resilience is sort of like the iceberg underneath the household income and underneath the credit score. We're seeing a lot of challenges by different segment. We're also seeing some very interesting changing consumer and financial behaviors as the pandemic unfolds. So many Canadians are rethinking their relationship to money, and we're expecting some more important changes to happen as more households are impacted by job losses and or reduced hours as a result of the pandemic. So at the national level, we're seeing that the mean financial resilience score for Canada rose from 49.58% in February, based on our baseline, to 55.58 in June. What does that mean? Essentially, that means that at the national level, we are approaching resilience. The significant increase was as a result of changing consumer and financial behaviors as a result of the lockdown, but also based on longer-term trends that we've seen from our data as it relates to how people manage their money, debt, daily financial management, etc. Swift, significant government support and also the financial institution support had a big impact as well on that score rising to June. As of October, our mean financial resilience score for Canada was 54.53. Here we see how the populations fall out, with essentially 7.2 million Canadians being financially resilient, and the large majority of us not. So you'll see the 2 segments in the middle, 55% of the population are essentially approaching resilience or financially vulnerable, with around 16% of Canadians in the most extremely vulnerable segment. So those people are unable to weather any financial stressors or shocks across our 9 behavioral indicators, whereas financially resilient people are able to endure financial shocks with little effect to their overall financial resilience. Here we see that there are many differences and disparities by province. So you can see, just for example, that there are significant differences even on the between the West Coast and the East Coast of Canada, and even between British Columbia and Alberta. Here we see that people can fall into any one of the financial resilience segments, regardless of household income. Why is this important? Well, essentially, you could have a household income of 150,000, but be financially vulnerable. Similarly, you can be a household with household income under 50,000 and be financially resilient. So we look at this across many different aspects and dimensions, as well as for bank customers. One of the things that we're quite concerned about, and we've been doing a lot of reporting around, is the growing financial resilience and financial health and resilience gap as a result of the pandemic. And so what that means is we're seeing that extremely vulnerable and financially vulnerable households are being more impacted by job losses and reduced hours as a result of the pandemic. Renters, part-time workers, underemployed Canadians, and more vulnerable Canadians are more represented in those extremely vulnerable and financially vulnerable households. And you'll see from this slide that, for example, in October, 77% of those people report that the pandemic has caused them significant financial hardship, compared to 69% just 3 months earlier. Similarly, we see that there's been a drop by half in financially resilient people saying that the pandemic has caused them hardship. So we measure this across many, many different dimensions, but this is something that we're really going to be watching over the next few months, and we think is really important for particularly financial institutions and others as they're looking to support more vulnerable customers and communities. This is also very important for the government as they're looking to build a financially inclusive, strong and resilient Canada through the recovery and beyond. So as I said, we're seeing tons of changing in consumer and financial behaviors by segment, with lots of interesting insights here. So just a couple to touch on here. You'll see that, for example, the extremely vulnerable, a much larger proportion of them have had to draw down on their savings, so 66%, that blue bubble on the right, compared to just 13% for financially resilient. So the key message here really is that one size does not fit all, and there's a really important need to provide more targeted support to different types of households based on their financial resilience, as well as other more traditional measures. Through the index, the self-reported credit score is one of the 9 indicators. So we are able to look at the proportion of Canadians that have self-reported excellent, very good, or good credit scores, and what their resilience looks like underneath. Again, that iceberg analogy. So what we're seeing here is that while 77% of households have strong reported credit scores, actually only about 36% of them are actually financially resilient underneath. And we're measuring a ton of different impacts that impact that, as well as sentiments and debt stressors and other financial stressors which are impacting Canadians. We're also measuring the extent to which Canadians have been impacted by job losses, reduced hours, as well as having seen income declines as a result of the pandemic. And so this is important because it highlights the opportunities for usage of the financial resilience score, as well as other data, to provide more nuanced credit and risk management and have deeper conversations with customers based on where they're at. Sorry, there we go. We're also tracking how different populations are being impacted through the pandemic. So these are just a few examples. We're able to do some quite important intersectional analysis. So what you can see, for example, here is we have self-employed business owners on the bottom left-hand side. We have been quite impacted by the pandemic, with our mean financial resilience score declining in June and October to 55.94 as of October. And business owners are also being quite impacted as it relates to job losses and or reduced hours or demand for their services. Similarly, we're seeing that part-time workers are being quite impacted, but also households with and homeowners with and without mortgages are being impacted. So I think the key message here is that there really is an opportunity to think about how different communities and customers can be supported through the pandemic as they're impacted. We're also able to do longitudinal analysis, which is really exciting for us. This is where what we've done here is we've tracked for 431 Canadians who answered both our June study and our October study. We're able to track what's actually happened to them during that 3-month period in terms of their financial resilience. And so what this shows is there's quite a lot of mobility within the index, and it can just take one or two setbacks for a household to move or slip downwards a segment. Similarly, there are different behaviors and or support mechanisms, etc., can help nudge people up a segment. So taking as an example the approaching resilience bucket, the purple bar there, we see that there 51% of those approaching resilience households stayed in the same segment between June and October, but 23% of people were nudged up to the financially resilient, and another 23% roughly actually slipped down the segment. So why is this important? Well, it really highlights that there is the opportunity for tracking and support of individual households right down to the individual level. And it also highlights that there's a lot of opportunity to help nudge and support your customers and borrowers as the pandemic unfolds. So I just wanted to thank you all so much. Really look forward to panel discussion. This has been a super, super brief summary. So if anyone wants more details on our detailed reports or would like to reach out, here are my contact details. And I really appreciate, look forward to the feedback from the discussion around what they're seeing in terms of the financial resilience of Canadians.
Thanks, Eloise. That was great. A lot of information. So now I want to move on to our panelists so that we can unpack some of this information and bring the audience some insights from our group. So the first thing that I wanted to throw out to our panelists was any feedback or comments that you have around some of the financial resilience and vulnerability insights from the index based on what you're seeing with your customers and through your organization. And feel free to jump in no particular order here.
Hey, it's Liz. I don't mind kicking it off.
Awesome.
Can you hear me okay? All right. So Elizabeth, thank you very much. And Eloise, that was absolutely fantastic. I personally was really keen to join today's panel because of the topic and the importance of resiliency, because it is incredibly important. And just a couple of takeaways from the presentation, a few things that really resonated with me. One is just the idea that we had 77% of individuals self-disclosed that they had strong credit scores, fair enough, but 37% are actually resilient, and that difference. And we've been seeing over time that our customers are getting much more educated about their credit scores, and credit scores are becoming much more available to individuals. At BMO, we enable customers that have online banking with us to be able to access their credit bureau score at no cost to them. And so they are able to see different mechanisms of improving it. But the truth is that is a bit of a backwards looking number. It is looking at the history of your payment behaviors, whereas a resiliency score, now I haven't unpacked exactly how this has been put together, but a resiliency score is likely giving us a bit of an indication as well of how resilient we could be to things like COVID, things like recessionary downturns. And I think that's what becomes really interesting here is, a part of BMO's philosophy is about providing our customers real financial progress and providing them that advice. And how does a resiliency score then provide an additional level of advice to our customers? I think it's very interesting.
Any other comments on that one? Maybe Kareem, you want to weigh in from the fintech side here?
Yeah, exactly. I echo a lot of what Liz just said right now. But the credit score is obviously a backward-looking number of what somebody has done in the past. And we're finding a lot of the customers are now looking for ways. They're very focused on financial literacy and education, and focused on the future and what they need to do in order to get back into what we call mainstream access to financial services, and credit score is one of those components. But a lot of our customers are very interested in budgeting and cash flow, things that they need to do. And I found the same level of interest and intrigue with the resilience score, because it is very forward looking. And discussions that I've had with Eloise also since learning about the resilience score is, how we can put this to work to be able to show individuals, Canadians, on what they need to do going forward in order to move away from financial vulnerability.
Yeah, no, I find that the distinction is quite different too, that there's this, more static number that people have access to, but it doesn't really give that full picture of financial health. Amit, not to pick on you so much here, but I was wondering if you had any insights and, thinking about some of the data that Eloise has presented from both the consumer side of things and also the small business, entrepreneur side of things, and whether you see any distinction in the data or takeaways that you're seeing, and what you're doing within your organization during these times to address those two types of populations.
Thanks, Elizabeth, and again, great presentation, Eloise. This is I would say the concept of resilience is is really, really important. As the first principles, what is good for Canada is good for Canadian banks, and as someone who's worked in banks across Canada and the US, I can say with deep conviction that while the Canadian banks are are exceptionally well managed, but definitely we can only remain resilient if our clients, the consumer clients and the business clients stay resilient. So absolutely, similar to what you have mentioned, we are seeing that that a lot of consumers obviously going through the pandemic need help and assistance, but the concept of resilience is extremely important, especially because the economy has changed significantly even pre-pandemic. We're looking at things like gig economy and what have you, where the conventional scoring methodologies are not sometimes as as relevant, or there are additional attributes, big data, artificial intelligence, etc., that has to be now deployed in order to understand a better understanding of what the client's future risk profile would look like. So it is there's good thought leadership over here, and as Liz said, we need to unpack the underlying algorithms a bit more. But as a concept, this makes complete sense, and we at RBC obviously want to make sure that our clients continue to be to increase their resilience over time, and we are giving them the right advice digitally. So you have tools like Know Me Now, which provide the right advice to our clients digitally to make sure that they are prepared for the next crisis. We believe that the economy will go through ups and downs, and making sure that our clients are resilient and have the right advice at the right time is able to make them better prepared for the next crisis whenever it comes.
Yeah, absolutely. And I think that goes to your point, Eloise, about future planning, not only at the private enterprise level, but also at the government level, where we all have a vested interest in making sure that Canadians as a whole are resilient, and what can we be doing there. So I think we're all pretty much firmly on the side of supporting financial resilience for consumers. So I wanted to walk through, strategies for using this data from sort of the soup to nuts of loans, and with a focus on loans and lending, obviously. So one of the things that I wanted to ask the group was, thinking about this data, what opportunities do you see for better risk management, better credit underwriting practices, better origination of those loans? And once again, I'll sort of open it up generally to the group to tell the audience a bit about what you're seeing, what you're thinking, and what you're doing, what kind of strategies you're employing, focusing a bit on the pandemic, but also, what your longer term strategies might be, because if there's one thing that we've just learned is that the data moves quickly. So what are we thinking ahead, not just December, but January, and then, on through the summer and beyond. So opening up now.
You know what, I'll kick it off one more time. How about that?
Awesome.
All right. Well, there's a couple of components to that question, and I'm going to go back to just how we've developed underwriting over time. And I expect that there's a lot of similarities amongst us in how we underwrite. And it really is back into history. It's using basic payment behavior, using the credit scores that are available, through our credit bureaus. And over time, we've been able to see that we can look at behavioral information, and we can use that to provide us better insights and the accounts that we're underwriting. And I think what you're seeing is now the progress of how we're just getting smarter and smarter to really, and the truth is provide customers good financial advice on what they can afford. And so again, in the past, more on the credit scores, but today it's more on behavioral scores. We have bankruptcy scores that we lean into. And I guess the question here, and it's likely more of what I expect to come, is that there'll be a resiliency piece to that as well. And I think as a customer, not just that I work at a bank, I would like to know what that is. I would like to have a better understanding of how I can improve my resiliency, not just today, but in the future. So just as like we're giving customers access to their FICO scores today, and they're able to, access to their scores today, not that one specifically, we can also in the future give them access to this, understand underlying what they can do to actually change it and improve it. And I think overall we can really empower people to be able to improve their credit and their financial health as they go forward.
Liz, I'd just like to jump in there on that one as well. I think from a technology point of view, certainly my background, my experience, spent a long time in obviously the UK, etc. as well. So looking at some of the innovation around open banking in particular as well, and that's where I see the future. So you kind of touched on it around that consumer consented data. I don't know if I can. I think you're still speaking, but I can't tell because your video's there. I don't want to be speaking over you.
I think Liz has a bit of a delay on her feed, that's all.
So I think Liz made a great point there around just some of that empowerment. So what we're seeing is a lot more emphasis on consumer consented data. That's where a consumer can actually provide far more data, and that's what the onset of open banking was all around. It was not just about understanding their credit commitments, but their true affordability, what they're spending, their spending habits, etc. And I think a lot of analysis I certainly saw was you'd find a lot of consumers weren't actually that aware of what they actually were spending and what they could afford to save potentially because they'd never been asked to do a budgeting exercise before they got into a position where they were asked to do one. So I think definitely some of the technology that's available nowadays will actually really help with not only underwriting at that initial onset, but then what do you do with that customer once they are a customer of yours? Because it's not like you're just going to discard them. It's okay. We assessed you at this point. Now you've had a financial impact, wherever it might be, a life-changing event. How do we now treat you? And how can we help you understand you a bit more? So I definitely think there's been so much progression there on the innovation of using both data and technology to really understand the consumers and give them a better path of how can we get you back onto that path of recovery quicker.
I think.
Sorry, go ahead, Corey.
Oh, thanks. So one of the other things that we see is that as institutions or companies that are providing credit and lending to these consumers, I think there's a lot of power in the consumerization of this technology and putting this power back into the hands of the consumer so that they know exactly where they are, where they stand, potentially even benchmarking. A lot of times we have consumers coming up looking to their financial institution and then finding out at the end stage that they don't qualify for something. So the concept around knowing before they go, know before you go, and putting that power and using indices such as this and putting that power back into the hands of the consumer so that they're empowered to make these decisions. Because you're right, Simon said something, consumer consented data. There's access to data from all different types of places other than just the credit score that determine the financial health of individuals.
And the other point there, just to note on that one, is just around that for a consumer, you mentioned something really important there. I think if a consumer's heard no more than once, they tend to have then a tendency to want to pull away and not look for advice and things. So I think it's about that. Can we pre-qualify you? Can we help you? And pre-delinquency is one of the toughest things to have a conversation with. This is almost like saying to one of your customers, we think you may need help, but you're not in trouble yet. But how do you broach that subject? And that's one of the toughest subjects to broach. But if you can say to people, there are solutions other than the heavily advertised options of going down bankruptcy, consumer proposals, or even going down to more payday loan, we have options, we have help. Just talk to us, whatever channel you want to. I think that's the future of it too. So it's about making consumers not only aware, but giving them that access to actually say, we're not necessarily going to say no, we may have a great solution for you.
Yeah, I would say another piece that that Simon you touched upon is that any macro event results in what I would call as so-called fallen angels who, in the absence of that crisis, would have been doing well, paying their bills on time, but because of this fall into financial distress or at least temporary economic difficulties. And the job of a good risk manager as well as a product manager is to differentiate them from other clients with similar credit histories or savings. So any kind of data that help us better differentiate these fallen angels from others would be very pertinent, even as we get into the recovery or the next economic cycle. And of course this pandemic would result in many more fallen angels compared to what a normal credit crisis would have resulted in. So yeah, these are great pieces of information which help banks, and then as Simon and Karim mentioned, help our clients as well get a better picture of their own financial situation.
Mm-hmm. It's sort of the next is free credit score 2.0, right? We've gone through that process in Canada and it's been very well received, and people have learned a lot, I think, from that. And now it's really getting this data and distributing it to small businesses and consumers in the same way that someone who would ordinarily, I take myself as that example. I'm a lawyer. I've got a great credit score. People are willing to give me lots of advice. I get very personalized advice. And so it's how do financial services providers give the same level of advice that I get in that personal setting, but by using all this data, you can democratize that in a way that you can provide more information to a broader swath of people and provide them with better options for the products and services. So this is all, very exciting, I think. One of the other aspects too on origination, of course, is identifying those underserved customers. So when Eloise, you're talking about someone who, they may have a low income, maybe they have a low score for whatever reason, but they're financially resilient. They could be an excellent customer if only you could get to them. So just wanted to hear from the panelists about maybe some strategies or ways that you're thinking about how to get that underserved customer and help them meet their needs so that they can grow their income, their business, whatever they're trying to do.
Yeah, so maybe I can go first and say that we have to be, first of all, be careful about using any piece of information from an advice or education point of view versus using it for let's say credit decisions, because anything that goes into credit decisions, we have to really make sure it doesn't lead to any kind of discrimination as an unintended consequence. So you just have to be very careful before we start thinking about new pieces of information before we start using it to qualify clients for something. That said, clearly, as the entire economy has been shifting significantly, and and incomes, etc., are a predictor of the past, and income is a very weighted concept sometimes because not everybody has a salaried job with well-defined incomes. There are the income for someone who's in a logistic trucking industry is going to be very, very different from somebody who is who's a salaried employee versus someone who's on commission versus somebody who's driving an Uber car. So yeah, we do need to look at information in very very different way. Like once upon a time, the economy was simple, and the same kind of information could do a pretty good job of providing good amount of discrimination. But going forward, we do believe there has to be more diversity in the type of attributes and the sources of attributes that we can and should use to make decisions.
Thanks. Any other comments on that from the other panelists?
Again, just around engagement, there's various different ways that you can engage with consumers nowadays. I mean, channel propensity is probably one of the biggest ones that I see as the indicator of why people probably don't get some advice or drop out of a process. So again, it's kind of understanding their preferred channel and then making things simple to do once you find that. Invariably, you will see that there's lots of money spent on marketing to find out how you can engage with a consumer. And then once you found out how to do it, you seem to lose that and then revert back to just phone calls or some, sort of standard type of information. So there's a lot more sort of two-way chat, SMS, email, whatever it might be, to try and engage with consumers, to just try and get that engagement, that initial engagement, build trust. And lots out there at the moment. And some really exciting things are actually coming as well, just to understand. And I saw a question that just popped up and said, you just can't rely on technology altogether. And I said, you're absolutely right. I agree with people. But to enable enough agents to speak to people and give that human touch, you're going to have to leverage some technology as well. Otherwise, it just won't have the capacity to be able to do that. But I do agree, there's kind of multiple ways of doing this.
And you're right there, Simon, is that there is a balance between the human touch, the white glove treatment, but we also deal with the customer of one. People want to transact in the way that's very familiar with them. The responses we get from a phone call versus an email sometimes are dwarfed by people responding to texts. It's just how people want to be able to communicate. Sometimes the text is people can hide. They'll respond when they want, but it's also very, it's right in your face. Whereas other people will pick up the phone and they want to speak to. So there is a balance in there, absolutely.
And I think what's going to be interesting is through the pandemic and probably next year, you're going to see a lot more people falling into a pre-delinquency and arrears situation. May never been there before. So they're going to have fear, embarrassment, all these kind of emotions that debt invokes. And I think it's so important that you open up your channels to try and engage with them. It works so well in the debt advice sector where they open up chat as an example to get people to eventually to speak to them. So it's just about building up trust and giving them, links of advice, budgeting advice, all those kind of things. You become the trusted advisor by doing that. And I think then they'll open up and want a phone call with you. So that's the key.
No, I think that's great. The other thing I would just add is that, there's obviously the ability through the index and scoring to track whether households have been impacted by job losses or reduced hours as a result of the pandemic, whether they've had to accept government support or not, and or defer loan or credit card payments, etc. And also, really importantly, whether people have access to social capital. So that is a close family or friend who I'm actually not only prepared to that I can turn to for financial help or in terms of hardship, but that I'm prepared to turn to. And so some of those more human elements within the index and from a financial scoring perspective can help to open up completely different human conversations with people that really come from a place of empathy and build trust towards more targeted relationships. I think the other piece I would just add is the power not only of giving this to consumers, but also bringing in the benchmarks so that people can understand, I am compared to renters who also are in Vancouver, who are also of my life stage. I'm doing okay from a financially resilience perspective, or actually here are 2 or 3 aspects where I may need to think about slightly tweaking my behaviors, or a couple of aspects where I'm not necessarily within this sort of peer index. So bringing in those insights as well so that people know that they're not alone and they have something to gauge, not only in terms of linkage to their life and financial goals, but linkage to what they can learn from peers who are also similar to them, can be powerful.
Mm-hmm. Yeah, there's a lot of psychology behind getting driving good behavior, and a lot out there, particularly now, and just on basic things like wearing masks, that we're more inclined to do these things if we believe that others are doing them as well. And I think that some of those principles also apply to some good financial habits as well. I'm just going to take a little break to turn to some of the questions that have come through, just so we don't lose sight of them. The first one, I believe, is going to be for you, Eloise, and I'll just read it out for those who may not be able to see it. The question is, how do the Canadian resiliency scores stack up against our neighbors to the south? Do you have US data comparisons?
Great question. Wonderful question. Thank you for that. So this index is actually the first index of its kind in the world. So we are the first to be measuring financial resilience as opposed to financial health. So south of the border, I have some wonderful colleagues, the Financial Health Network. They have been measuring the financial health of Americans based on different indicators for a number of years. So they're tracking that, but it's a very different measurement. The concept of financial resilience as we have defined it is very unique. So no, we don't have any benchmarks for south of the border.
Thanks, Eloise. And I'll take the other one too that's in the queue. The question is, as a credit counseling agency, we are interested in how lenders are innovating to work with clients and structure products to help actively reduce credit risk rather than treating risk as an external metric. Who wants to tackle that one?
Elizabeth, could I ask you to just repeat that question again?
Absolutely. As a credit counseling agency, we are interested in how lenders are innovating to work with clients and structure products to help actively reduce credit risk rather than treating risk as an external metric.
Interesting.
So I think they're, just to paraphrase, a sort of strategies in terms of product development. Maybe an example I can think of is where people are laddering their customers to different products. That might be.
Yeah, that's what I said. So one of the things that we're doing at Marvel is focusing on the goals of the individual. We are all snowflakes are snow, but we're all unique in our own ways. So we have a lot of financially challenged and vulnerable consumers, but each one of them have goals. One of the challenges that we see for them is that they've gone through some level of a declined event, either at the point of sale or a mortgage or wanting to buy a car. And they're looking for help in improving their financial wellness, but at the end, they still want that car. They still want that house. They still want to be able to buy that product that they were initially declined for. So working with these individuals and providing them technology, things such as simple as a credit report, which most of us have a hard time understanding if you're looking at it just pulled from, but again, I use the word consumerize it, but put it in a way that we can educate them on what that credit report is telling them, whether it's number of inquiries to credit utilization to what an R9 is, and helping them understand exactly what they need to do in order to kind of remove some of that risk themselves before they go to a lender looking for additional credit.
Thanks, Karim. Anyone else have anything to add on that one?
Yeah, I can maybe add to that by saying Karim is right. Like the on the bank side, like our job kind of starts with making sure that that our clients are set up for success, and part of it is to give the right advice to the client, which makes the most sense for the client, and then how do you do it in a digital environment becomes the version 2.0 of it. But that is what we firmly believe. Like if there is a client with with credit card debt and has a line of credit with a lower rate, how do we move that client onto a lower rate, but also in the process educate the client that that's not shouldn't become a path to taking on even more debt. Like that's supposed to be a tool to help you reduce your debt. So that's the that's the kind of advice that we are trying to proactively provide to our clients, even if in the short term that might mean that the bank makes slightly less money on finance charges, but but we do believe that that we have to ultimately look at the lifetime value of a client and make or help the client make decisions which are in their best interest over the long term. So yeah, so we have our tool called Nomi, which saves or has saved our clients thousands and thousands of dollars in terms of providing them with the right advice around how to structure their products more efficiently. And then related to that is our free credit scores or products like those. So we have our own version of it that we have developed in partnership with a bureau, where not only do we educate clients about what their score is, but what can they do to improve those scores in a time-bound manner. So that's a kind of advice and education that we hope at least to provide the tools to do that. And if clients are interested, they can rely on us to help them meet their financial goals or their credit goals over time.
Thanks, Al. So I wanted to turn now, moving, and I think we're sort of doing it, frankly, through the flow of the conversation, but I do want to make sure that we get to this and hear the panel's thoughts on, you've got the customer, so we're leveraging data, we're getting the right customers, we're servicing them in the right ways in terms of the products that we're offering. What do we do then in terms of, the servicing of that customer in terms of collections, customer support, certainly now for households that are more financially vulnerable or have been impacted by the pandemic? What are some things that we're seeing in terms of helping those customers? And in some cases for lenders, that might be quite inundated with these calls, that the volume that you might be dealing with may have ramped up during this period. And so what are you doing to deal with that volume and to deal with these very human problems, but in a way that's scalable and manageable? So I'll open it up again.
I'm happy to just give you a general overview of obviously what I've been seeing, I suppose, from a solution perspective. I think there's certainly some challenges for businesses once you start to see an increase in number of people coming into more of a collections environment. Not only necessarily in the budgeting collections, so there's a lot of money necessarily in sort of more the risk areas and the front end, but there are some other challenges too around mindset changes and how you deal with customers, etc. But you need to engage with some of the technology that's there to free up your agent's time. I do believe that people need to speak to people, but if you're going to have a 45-minute conversation with someone, then that's typically far longer than a 10-minute conversation with someone that you might have previously done. So smarter ways of now gaining some more time back, in particular around budgeting pieces and understand affordability, where you can start a conversation with a consumer, you can send them a link, they can actually fill in an I&E form, go away, find that information, come back to you, and you can give them a resolution. So there's real smart ways now that people are using those kind of budgeting tools to help people. And it might be the first time they've ever done it as well. So that's some of the things I'm seeing in there as well as trying to use more two-way SMS tools where an agent can have multiple conversations with people. So they can actually have up to 4 or 5 conversations with different people using like a chat functionality or a two-way SMS functionality. So they're probably some of the best ways I'm seeing at the moment for dealing with capacity. Certainly during the pandemic, what we did see was call waiting times exceeding over an hour. People getting very frustrated. So again, even things such as instead of staying on a call, there's a message in there saying, can we send you a message? Can we divert you to a page? Can we help you in any other way rather than keeping you on the line and creating frustration? So lots and lots of great innovative tools out there.
Excellent. Anything, maybe Liz or Amit or Karim on, some of the strategies that you've been using during the pandemic that you can share with the audience?
Well, I think the simple answer to that, Elizabeth, is being very consultative. This is we've heard the word unprecedented over and over again, right? And it is a very challenging environment. So we also, when we see consumers reaching out to us and they're in a situation, I need a loan. There was a gentleman, I think I mentioned a couple of days ago, he's been living in his car for the last 3 months. And he's just looking for money and nobody's willing to talk to him. And it's just a very challenging environment. So first of all, educating the consumer and being more consultative. You're right, not just a 10-minute phone call, but it may turn into a 30-minute phone call. And you may not be able to help this individual, but a lot of times as these individuals are going down that downward spiral, is to speak to their lender first. We've seen a lot of payouts during COVID. Even with our deferral program, we didn't see a huge spike in delinquencies, but we've also seen a lot of consumers bypass the collections event. We didn't even have to call them for their first collection or the first 30 days missed payment. We just got notice from a trustee that this individual is insolvent. And that was fascinating to see, where they've just kind of leapfrogged the collections process and got right down into insolvency. So I think the first thing is just continuing to speak to these individuals and reaching out to them and taking the time to speak to them. But the other thing is also educating and training the staff, because a lot of people that are working with these consumers are also dealing with something that is brand new as well. And so I realize now that it's not just so much focusing on your own value chain, but also value networks of partners within your ecosystem on people that you might be able to refer consumers to for advice or solutions that you may not have yourself in helping these individuals.
Yeah, that's a really good point, actually. That's a great point on that one about referring people to certainly debt counseling and going down those routes and not just thinking that their only pathway is insolvency. But I find it might not be so surprising. And as an outsider looking in, I've only been in Canada for the last 3 years, but I certainly hear and I see a lot of advertising, we can help you, we can recover you, we're a debt advice specialist, et cetera, et cetera. I don't know if that's always necessarily the right path, but maybe the consumer doesn't know any other path because no one's speaking to them, right? So I think, again, it goes back to that awareness and also the fear of not being told no. Because that once you've been told no once, it's a pretty scary thing to pick up the phone and ask the next person the same question, will you help me? So I think you made some great points there.
Yeah, and particularly, I think that what's interesting is, the bypassing of the lender, which is not in any lender's best interest, right? Because if you can make an arrangement with your customer, you're probably going to get more cents on the dollar than if they go into insolvency. So I think it sort of behooves all the lenders in the audience there to think about that as a kind of a critical data point as we move through, and to think of some strategies in outreach for your customers so that you can help them and educate them as well, because obviously the consequences of bankruptcy, I think, maybe are not well understood by the average consumer. They just think of it as maybe a free ticket, and we all know that that is absolutely not the case, and that there are some very long-term repercussions to that. Liz, I don't know if you were trying to step in there. I saw I think you were on mute. There were some headset changes there. So I think you're still on mute. But if you did want to jump in, no, it's not happening.
Can you hear me now?
Yes.
Can you hear me? Okay.
Yes.
So apologies about that. I was on mute. Yeah, I do want to jump in because it is incredibly important around how we help our customers during challenging times. I absolutely hear you on the things that everyone has said here about good financial advice. And certainly in the early days of COVID, all the FIs came together and offered multiple deferral programs to customers throughout all of the products, whether it be mortgages, car loans, or any other product, including credit cards. And a lot of the financial advice was not just, simply taking deferrals. It really was around, well, are you in the right product for you? And what Amit said really resonated, because sometimes it is a conversation that you're not in the right product. We need to manage you, or we need to recommend maybe something different for you, or a different approach, or a different way of thinking about how you're making your payments, and possibly consolidating some of that debt to one payment amount. And so we're definitely working with our customers every day, and it can be very individual. So there's one thing about an SMS on a payment reminder, but it's another thing when you're trying to look at your holistic financial situation. And we do find that in those cases, customers, particularly during COVID, were calling us on the phone if they were uncomfortable coming into the branch, but many times coming into the branch because they really wanted that personalized understanding of where they are and how to manage going forward during this difficult time.
And Liz, I think you made a great point there. And I just wonder if there was some underlying situations already with consumers, and COVID maybe accelerated that conversation with you guys. And if the deferments weren't offered, would they have ever have come to you and sort of disclosed some of those? And would you have ever known they're not in the wrong product? So it's almost like out of these terrible situation, maybe you've actually found some positive kind of maybe longer term plans for these people because they weren't in the right product in the first place. I just find that quite an interesting byproduct, possibly of a bad situation.
Mm-hmm.
Well, you
Yeah,
also mentioned about the challenges of getting to pre-delinquency conversations. We do have pre-delinquency conversations with our customers. We do have targeting where we're seeing, some changing behaviors, and we reach out and we're absolutely asking, is there anything that we can do to help? But it is around having those conversations early, because once you get far into the late stage of non-payment, it does become much more difficult for an individual, and their choices actually start to become more limited.
Yeah, absolutely. And just to put in the legal side of things too, as we move towards more legislation on fair treatment of customers and product suitability, I think the lessons that we're learning from the pandemic are going to serve FIs and other lenders quite well. I know we've only got 4 more minutes left, so I'm just going to look to see if we've got some other questions, and we do, from our audience. So here's one, again, on the scores themselves. The question is, are you able to correlate macroeconomic trends and impact on resilience scores? This could be critical for expected credit losses in financial reporting.
Yeah, so great question. I mean, I think we see the Financial Resilience Index as being a complement to GDP and other traditional measures that economists and government and other organizations are tracking. And the government is very interested in the index as a result in terms of the ability to look at what's happening at the national level for Canadians' financial resilience. So I think we're just at the very beginning of a very exciting journey. We absolutely don't have all the answers, but I think we do see the potential to correlate the financial resilience of households at the national level with other indicators to help guide and inform policymakers, business leaders, as well as bankers and the wider ecosystem to do more to support not only individuals, but also families and communities. And again, not only through the pandemic, but as a medium and long-term strategy, because it's the right thing to do for our country and our economy.
Thanks for that. I'll throw out another one from our audience. Buy now, pay later programs have grown exponentially since the pandemic, especially the ones who offer 0% interest programs. Did this come up in your research? And if so, which groups adopted these types of financing programs?
Yeah, great question. So we do track lots of different consumer and financial behaviors, as well as usage of different products, including predatory lending and payday loans. And we do see that extremely vulnerable households, not surprisingly, have a much higher take-up of those products and are also much more challenged in terms of access to financial education and help than more resilient households. We don't track installment loans or buy now, pay later programs yet, but that could be something that we could do in the future if of interest.
Yeah, I think that's a really interesting point too, because I think the buy now, pay later market is possibly the fastest growing market in Canada if you actually look at them. Certainly, some of the organizations I've seen out there in the marketplace, PayBright, Flexity, I mean, these guys are really growing. So I can see the enticement too, especially if you need to sort of spread out those payments as such. I guess we won't be able to know if it's a long-term positive thing or not, but I can understand certainly during times where people have had maybe a loss in revenue, that this could be maybe the only way to
I think that's exactly the point for that, is that the financially stressed or vulnerable are not so much focused on the cost of the credit, but what can I afford right now in order to get that couch or get that oven.
And especially if you need it too. I mean, it's not always, we always talk about luxury goods, but you know, some people might need necessities too. So they need a washing machine or their car fix, whatever it might be. You know, it's not always about luxury goods. Sometimes these are necessities for people and they can't go anywhere else. So that's why they turn to these type of these type of opportunities, these type of loans. So I think it'd be interesting to see how this all pans out in the next year or so. And it'd be really interesting, because I know for one thing, the collection agencies are all gearing up, expecting a lot more cases to come to them. And, you know, with that, you know, that kind of assumes maybe also that there's going to be a lot of people fall through the processes of maybe traditional lenders today, because maybe we don't have the capacity to talk to them, or people choose not to speak because they're scared, whichever way. But I think it's going to be a really interesting year.
Absolutely. I think that's the best closer I could give. It is going to be an interesting year. And I think we're, you know, with bated breath, right? All we can do is try our best, look at the data, look at what we're seeing, and do our best to, you know, help our customers drive business, all those good things. So thank you everyone for our panel. Excellent. Really enjoyed this discussion. Thank you for our audience, and thank you to the Canadian Lenders Association for bringing this all together, and for the opportunity to present these really great ideas. There's probably a few questions that I didn't get to in the chat. Please feel free to reach out afterwards. We should all be able to be accessed through the Canadian Lenders Association. And thank you again for attending, and have a great rest of the day, and happy 2021.
Thanks, Elizabeth.
Thank you.
Thanks, Elizabeth.
Thank you.
Thank you.